So basically, there are these things called miners. And so the miners are computers. You plug your computer into the wall. You can't really hold them. They're actually inside the computer. It's part of the blockchain and you can spend it. There's math and computers and then that makes a coin. Yeah, you can buy things like other cryptocurrencies with it. You can't actually spend it, but I'm just trying to say, if you want to be rich, you can put your money in Bitcoin and then you'll be rich. It's not that hard. I'm not yelling, you're yelling. Just buy it.
That's pretty much how Bitcoin works, simply put. Now today, we're going to talk about what banks have said about Bitcoin. 2 German banks have published a study regarding Bitcoin with interesting results. Now, as far as I understand the banking system over in Germany, it's far more decentralized than, say, the UK is, for example. They have hundreds, if not up to 1,000 banks in Germany. Let me just fact check this before I say something stupid. There are currently 371 credit institutions, plus 987 local cooperative banks and 421 local savings. Okay, quite a few banks compared to the UK's 5 major banks. This is why I would expect no honesty from the UK banks, because if you think about it, things are working really great for them. Why rock the boat? Treat everyone and every new thing as a potential threat. But I could see some honesty coming from a German bank, in contrast. Anywho, megatrend digitalization. Is Bitcoin outshining gold? Let's get straight to the juicy parts of this study, the price predictions. The most intriguing question, of course, is what the future will bring. What is certain is that Bitcoin's stock-to-flow ratio will increase drastically in May 2020. Made a video on stock-to-flow ratio before. Very simply put, it's a way of determining an asset's value based upon its supply. A little bit more to it than that, but yes. So the stock-to-flow ratio will increase drastically in May after the next halving, from around 25.8 currently to almost 53. By contrast, gold stock-to-flow ratio is currently in the vicinity of 58 and will only be significantly, if at all, higher next May. If the May 2020 stock-to-flow ratio for Bitcoin is factored into the model, a vertiginous price of around 90,000 USD emerges. What does this mean? Extremely high or steep? Okay, fair enough. Now there are, of course, flaws with future price predictions, including this one. They even admit it themselves. However, there are a couple of things to note when it comes to this vertiginous prediction. First thing of note is that while analysis in the past has not been spot on, not at all in some points, being totally honest, the overall picture is quite an accurate one. In fact, one of the most accurate price prediction models we currently have for Bitcoin. A simple way of putting it is that the stock-to-flow ratio is the road on which a drunkard, Bitcoin's market value, staggers around without ever crashing out through the road barriers.
Feeling my way through the darkness, guided by a beating heart.
Despite the last halving occurring here not giving an immediate price reaction, it did eventually snap back up. This is in contrast with 2012's halving, where it was almost an immediate price increase. Second thing of note is that with the current price of Bitcoin today, it is lower than what the stock-to-flow model predicts, although not by a lot. But if Bitcoin is to fall from here, well, we can throw this indicator on top of a pile of growing indicators showing that Bitcoin is becoming oversold. Here we are with the $90,000 to $100,000 price prediction sometime mid-2020. Whether Bitcoin would immediately get to that price level after the halving, like they're predicting, like it pretty much did with 2012's, I'd say is doubtful, because we're going much higher than that. Am I right? This is great for Bitcoin. But data shows it wouldn't be too much longer before it does. Third thing of note, and this is the bit that I really enjoyed reading actually. Conclusion: Bitcoin was conceived to be an even harder asset than gold. It becomes clear that Bitcoin has been conceived as an ultra-hard type of money. In 2024, when the next halving is due to take place, its degree of hardness will inexorably increase even further to a level unprecedented in human history, a stock-to-flow ratio of more than 100. Nobody really knows what repercussions such a monetary standard would have. One thing is clear. If Bitcoin is indeed to become the money of the 21st century, it will be because its properties, above all its high degree of hardness, have been preferred to those of alternative types of money. It's just a better way of doing things.
Way on the first cow here, who's got 55, 55, 55,
Now this is great research, but for those who don't understand what is specifically referred to when they say hard money, this is your gold, this is your silver, this is your platinum, this is even your antique baseball cards, funnily enough, outperforming the S&P 500 for many years now. The USD was once hard money when it was backed by gold. So in contrast, credit, debt, loans, fiat in general, let's be honest, is very, very soft. And soft in this case is not good. Bitcoin is ultra hard and easily divisible. That's quite a big thing. Imagine you have gold and you want to pay for your dinner, for example. You need to bring in an analyzer, a sophisticated weighing machine, shave off some of that gold. Ridiculous, right? Not even to mention the tips. And don't even consider paying for something with a baseball card. So while Bitcoin is, of course, not as convenient for most things as a credit card or cash, there are certainly circumstances where Bitcoin is more convenient than those two. But for the most part, I think that's fair to say it is by far the most convenient ultra hard money out there by a long margin. But my fees. Yes, I know. Bitcoin isn't perfect. Not everything can be Cardano, for example. Little throwback to the 90s kids still watching me. Final take from this research, I got a little bit carried away there. A llama market might very well be on the cards here. Not at all unexpected at this point.
I'm just a regular, everyday, normal motherfucker.
The most interesting thing currently price-wise, as this study infers, is that the next halving event has not been priced in. If it had, we would be projected to be higher than we currently are. And that, ladies and gentlemen, is good for you. What was the actual point of talking about it? Especially considering Bitcoin historically has not given you the best return on investments compared to many, many alts, but is, generally speaking, a safer bet. It just feels stupid to misjudge a situation like that. But let's take a look at the top 20 coins' performance over the last 6 months. Am I wrong in my assumptions? Spoiler? Maybe. This data is from Coin Codex. I actually am just looking at nothing, but it should be there. The top 20 coins' performance versus USD.